Now let's get right to Ted Oakley, founder of Oxbow Advisors. He's got some picks for us. He has some strategies of how to invest in 2020. You said you have two ideas, two strategies. Explain what I'm supposed to do with my money.
Well, Nicole, we work with a lot of people that have had significant cash inputs, particularly selling companies and things like that. So we run two sides. We'll typically have a growth strategy, which we own common stocks in. And then we'll have an income strategy, which we'll own various things. We can own corporates, preferreds, municipals. So we sort of have a two-prong approach. And we're in both strategies right now. We're fairly liquid, more liquid than we have been, I'd say, in the last 2 years. What we're really trying to find on the income side are cash flows of things. As an example now, we're buying into some energy items that pay, 7, 8, 9%.
Right.
We look for that
Dividend
kind of thing.
payers.
You mentioned Broadcom earlier. We own a Broadcom convertible preferred that pays us about 7.5 to 8%.
Right.
That's the type of thing we're looking for in that strategy.
And you really need experts to sort of explain to you how to get convertible preferreds and municipals and to try and work your portfolio like that. It's not the kind of thing you do at home. You know what I mean?
That's true, though. I would say that an individual investor would have a very hard time of working a municipal, and we do a lot of municipal strategy, but I think they would have a hard time of doing that themselves.
What they can do, though, is buy a stock. And that's on your growth strategy side. So let's get to that. If someone was interested in maybe getting away a little bit from technology, you say a name like Unilever may be a winner, a good buy.
Well, it is, because almost everybody that looks at stocks is going to use the products of Unilever. Everything from Lipton tea to Dove soap to there's 400 or 500 consumer brands that you all know. The thing about Unilever, it normally trades at a premium to what the S&P multiple is, and right now it's not. It pays a nice dividend. We came into the stock early in the year at about a 3.6% dividend. It's a little lower than that now, but not a bad dividend.
Right.
So it's something we look at that. And then, we really taken a position in Booking because we like that industry.
Now you've moved on to Booking.com, BKNG, yeah.
Right, and I'm sorry to jump ahead, but what happened is on Booking, it's a growth stock. It's not going to pay a dividend, but it is a company that is in the midst of what we like. We like the online travel business, and if you look at it, they are a premier person and a premier company in that group. So we like that company as a growth company.
So when we talk about these two, for the Unilever story, and it's moved higher over the last year. It's up about 7.5% over 1 year. You mentioned the staples that we need: Lipton tea, Dove soap. These, regardless of the economy, that's why you think it's this kind of winner. At the same time, it wasn't long ago that I saw sales were waning. There's some concern there too. So even that is not completely foolproof.
That's true, and a little bit of that is what's happened. They sold a couple of companies off. They sold some companies off in 19.
Right.
And what happened on that, I think people look at that and think, well, that's not working. But if you really want in a brand company, you want them to really get rid of the brands that are really not working for them and add to the brands or new brands that can work for them. And I think that's one of the reasons the stock suffered a little bit last year, but it's not back at a new high right now.
Right. So we'll continue to watch that one. You mentioned Booking is another one. That's based on the strong consumer, right? They got to book and go places and do fun things. What about the Fang group? I mean, a lot of people always are asking us about the Fang names.
Well, you have to look at them as being, very, very fully priced. I mean, as a group, those top 6 stocks account for about 20% of the S&P. So if we're buying one and we own it, but if we were looking at one and you had to take one today, we would probably go with Amazon because of the types of businesses they're in and where they are. We own some of the others, but they're not full positions for us right now.
Right. With Amazon, when you talk about the types of businesses, is it the web services? Is it e-commerce? I mean, what is it about Amazon that you like better than the rest of the Fang group?
Well, if you look at what's going to happen in those 3 primary businesses, first of all, transitioning to the cloud for businesses is a big thing, and there's a lot of runway left in that business. E-commerce is great as well. But they have the ability to really work in that business, I think, as well as anybody.
Right. And now the big picture outlook for the market, as you know, we'll have the election in the back half of the year. Do you think we'll be higher by the end of the year? I mean, what do you
I would guess not.
Really?
If we were guessing, yeah, just because of where pricing is.
Right.
I think people overestimate.
Not on Amazon. I mean, on the S&P 500.
Yeah,
right?
on the S&P though, I think people probably overestimating what earnings can do this year. If you looked at the average estimate this year for the year, it's about 8 or 9% up. I don't think we even get close to it.
Right. I mean, you don't want negative. That would be.
No, but last year they started out.
That's what I'm saying.
Thinking we were going to really be positive, and we ended up negative.
Right. That's what I'm saying. But you think that we might be under some pressure this year. Okay. We'll have to circle back and revisit it all. Great to see you.
All right.
Thank you so much. Ted
Thanks,
Oakley,
Nicole.
founder of Oxbow Advisors.